Okay, folks, are you guys ready for the market update, 18 April 2020? What's going on in the financial markets during this COVID-19 crisis? You guys ready? I got my coffee, got my sheet. I'm ready. Let's go. But before I continue, if you haven't already, please do check out this video that I made earlier today, Stock Market Cycles, Market Psychology, and the Average Investor. In this market update, I'll be using some of the things that I explained in this particular presentation, and let me guarantee that you will learn something new in this one. I guarantee, okay? The stuff that I talk about in this particular video, you're not gonna get it in many books, and you're not gonna get it by watching free YouTube trading stuff, okay? I guarantee it. Please go there, and if you go to this video and watch this, whether you're a professional or not professional, if you didn't learn a single new thing, message me and I'll buy you some coffee. In the meantime, hey, if you haven't already subscribed to quantzombie.com and Financial Market Psychology Wisdom, here's where you get timely updates, right? Maybe if you had subscribed to these two sites, you would be one of the few people to have heard the 1% of voices like me say that there could be an intermediate bottom that lasted for a few weeks and I'm starting to buy stocks. When I first said it three weeks ago, many people laughed at me. They showed me Goldman Sachs analysts, what they say. They show me fund managers that say certain things. They say these guys are so bearish, how can that be? And they laughed at me. I can only give my honest perspective. And what's the difference between me and them? My specialty is in bottom finding. That's how I survived the 2009 financial crisis. So please, if you haven't done so already, check this two out. If you want to know more about my journey in Christianity and how I recovered from an incurable disease, please check out this ministry site over here. Links will be at the bottom of the description. Sign up for Quant Zombie. I mean, you get to see my blog posts basically, right? And if you sign up, you get to see the blog posts when they come out. And these are all time sensitive. The post that you will see later came out that I came out to let people be aware of the bottom of the stock market came the day before the bottom itself. So don't take my word for it. Let's go on. Okay, let's catch up to this point. Okay, so as of yesterday, here's where the S&P was, right over here. Okay, so let's catch up. Now, I was silent for a couple of months because I don't do this full-time or professionally anymore. I'm an ex-analyst, right? But I noticed that, you know what, over here, I think that a bottom was going to occur. I really thought so. I didn't want to say anything because what's the point of saying something? If you say something and you're wrong, people will just laugh at you. And there's so much negativity out there. It's so easy to feel the fear out there and just agree with everybody. But I just saw certain signals that I thought increased the probability that, hey, you know what? I think the probability of a bottom is much higher than a non-bottom. So basically, this is where my first blog, I basically said this: an intermediate bottom might be in the process. A chance that the selling momentum may not free fall means it's not gonna free fall for a few weeks. And this is the part that people were so skeptical. I said that for a few weeks you won't get a free fall, and that the fear is worse than reality for now. And I'm nibbling at stocks, and I basically told people the stocks I was nibbling on. By the way, all these particular stocks, right, have all surged between 20 and 50, 60, 70% since, okay? And that's because I nailed it basically the day before it bottomed. Okay, so going forward, 1 week later, my next post, I said, okay, my thesis worked. This thesis worked. Take profit from those that surged, right here, and buy some laggards, right? And fortunately, the probabilities were in my favor, thank God. Yeah, we had a dip. So if you took profit here, you would have even saved some money. And I said that I'm going to buy laggards, the stuff that have retraced, I'm going to buy them. Okay, then I list even more stuff I was looking at. Over here is when I explain a little bit more about why I believe there's going to be a bottom. So please check out this, especially this particular one, coronavirus market update, short-term bottom or not. Here's a plan. And I set my personal strategy here. By the way, disclaimer, okay, everything I say today is for educational purposes only, okay? It's not an encouragement to buy or sell. If you want to buy or sell, please engage your own due diligence and consult your personal financial advisor, okay? Who am I? I'm just a dumbass that people in suits don't care about. So anyway, so just this is what I said over here. Buy stocks that won't go bankrupt as long as the MACD, which is here, as long as it hasn't cut downward. See, it cut upward here. The black line cut the red upward. As long as it doesn't cut downward, assume that it's going to be up. And I said that here. Assume it's going to be up. Yep. And I said that assume value investors and insiders will accumulate at these levels here. That means here. And sure enough, the price dropped and there was accumulation and it went forward. Okay. And finally, over here, I just gave a particular recommendation for because people think that everything they see so far is market update, sentiment, technicals, and quant. So I also do some fundamental analysis, and so I just share some companies that I know really well. So over here, I said, if you want to buy something, here's one thing. The reason why I can suggest this one is because I know that this will not go bust. This is not a company that will go to 0 cents. And the reason why is because at that time, it was trading at 50 cents. 50 Singapore cents per share, and this particular company has 45 cents in net cash. In its bank account has 45 cents, and they basically made 8 cents a share last year. So even if you reduce how much they make from 8 cents to even 1 cent, it's still worth it. And I basically said that it's worth 55 cents right now, like right now. So, sorry, I said that Bell Electronics is worth 60 cents even if we are really in a financial crisis, and is worth 55 cents right now even if there's a financial crisis and there's a COVID that even goes worse. And then the price actually climbed from 50 cents to 62 cents today. Okay, so those are the recent posts, how we got to this point. What's going on now? Okay, so let's do that. So first of all, let me explain why I thought that the markets wouldn't free fall for a few weeks, okay? So while everybody was looking at price patterns, you had technical analysts saying, oh my goodness, we've had a ginormous fall for 1 month, and every bull market lasts for 1 year. So this cannot be the end. It's definitely going down. And they will compare the bear market to what we saw on, to what we see in 2009 and other recessions and even depressions, okay? But in this case, right, when you're looking at the market, nuance really matters. The technical analyst will see some things. The sentiment analysts will see certain things. The fundamental analyst will see something different. If you can put it all together, you realize that sometimes the picture is a bit different, and that's what I saw. So in this particular case, right, let me give you a pro tip right now. How far and how long a move is not a reliable indicator of whether you're overbought or oversold. To do that, right, please refer to my last presentation to have a more accurate understanding of whether you're overstretched, overbought, or whether it's more likely to come down or more likely to go up. You need to analyze what's going on at the price at that time based on the market participants. And I mean, at this time, who's buying, who's selling? Is it the dumb money that's buying, or is it the smart money that's buying? That is a much better indication of where you are at. And that's what I saw. So basically over here, this is basically the monthly CEO buy-sell ratio in the S&P 500. So this tells you that these are the quantified amounts of CEOs buying shares in their own company. So, and it's a ratio between those that buy and those that sell. So over here, recently in that big drop that we had a big surge in insider buying and selling, such that the amount of CEOs that were buying their own stock was about 2:1 times versus those that sold. And the interesting thing about this is that the last time you saw such extreme buying, right, of this sort was in the first drop of the financial crisis over here. Can you see the first plunge here? Big plunge. And this first big plunge actually started a bottoming process. That's exactly what happened here. So even though people can say this is only like 1 month and this took a long time to develop, the point is that the forced behavior and fear panic selling past reality and valuation occurred already. That's the thing that I saw, and I alerted people to that. And then you can corroborate it with this. Here is the VIX. The VIX is the volatility index. Okay, I advise you to go and do some more reading about it. But what a VIX really is that it measures how much the broad markets are so-called expecting the next month is going to be in terms of fear and volatility. So essentially, and And this measures basically the pricing or what we call implied volatility in the S&P 500 stock options. Implied volatility basically is a measure of how much more option traders are willing to pay because they expect high volatility. So when you see something that spikes really high like that, it indicates that the market is really overstretched. It's really, really bearish and really, really overstretched. And you can see every time when this happens, when things calm down, prices usually tend to recover. So when this spiked over here in 2009, that corresponds to this surge down here. Once people started to get their wits back, right, the price actually recovered and consolidated for a few weeks before people start looking at fundamentals and essentially the market drifting lower because of fundamentals, right? But the big surge here is, you can say, it is emotional trading. And in this case here, now, now and also then, you had a lot of not just emotional trading, you had also a lot of forced liquidation from some funds. Because the thing plummeted so fast, some funds had to bail out quickly, and then essentially there's more selling than what they really wanted. So these things have to normalize first. So when you see both the VIX being so extreme and the insider buying, which is here, extreme at the same time, what does it tell you? It tells you that the whole market is panicking, except for literally the smartest people in the room. So the question is, who do you want to be with? If you sell at that time, you're basically joining everyone in the market. If you buy at that time, you are joining the smartest people in the room, the CEOs that know the companies that they're buying better than most people. So question, can the market still go down further? Of course. Insider buying doesn't guarantee that they guarantee that the price won't go down further. But what it does is that if you had to assign a probability, you would say this: there's a 90% chance they bought it at a very good price, and a 10% chance that they underestimated the power of the Covid-19 and they couldn't do their calculations properly, in which case the price will be much lower than what they bought it at. But statistics tell you that when insiders buy, they tend to outperform the average investor by quite a big margin, if you know who to look at. So I go to probability. So the two things, right? Look at the VIX, look at insider trading, tells you a different picture. That's how I suspected that this was an intermediate bottom. This VIX has to normalize first, and I knew there was great support because of all the insider trading that came in. So this tells me that all the strong hands will be coming in at that time. So let's go now. Let's take a closer look at 2008's market crash. That's here. As you can see, this line in early October, that's when the VIX spiked really high. Okay, that caused the first plunge here, boom. So for me, I don't really care about the back here. What we saw in the last crash that happened last month, I saw this part of it. And you notice when this happens, what happens when you have such forced selling and such historical VIX? It washes out a lot of emotional people. So that what happens usually then is that, and don't forget, the financial crisis hasn't even occurred yet. People were trading on assuming how badly COVID will affect the economy, how certain companies might go bankrupt, who might survive. People were speculating on all those things. None of them actually have happened yet. So you need time for this reality to set in, right? You don't know if you need time for companies to start reporting to see who really survives, who really doesn't. So what happened here is that there was a big normalization as all the short sellers had to stop, and all the people who have forced liquidations were slowly buying back. And then after that, what you have is a drift where the free fall isn't as bad as one before, where people are listening to like real fundamentals, right? And essentially we were range bound for a few weeks, right? One whole month before you finally got taken down to another low, and then you consolidated quite a bit before it got taken down to another low. But you can see that each of these consolidations are quite hefty. They're not small. Here to here, right, is almost 25%. Here 60 to 75, here to here is about 25% as well. So even in this consolidation here, if you buy the bombed out stocks, you can still recover 25%, 20-25% of what you've lost. So it's important to know these bottoms. But the key thing also is that we don't really know if this is if this was a true bottom. You don't really know. You see, you can only speculate. This is a bottom, but we don't know if it's the final bottom. Okay. So you still got to place your bets based on a probability that this is a bottom. It's probably cheap, because on the long term, right, it's still cheap. If you had bought your stocks here, yes, you missed this bottom and this bottom, but guess what? In less than a year, less than 1 year's time, you've already made money. And in 2 years' time, you've actually made very good money. So the point is that, oh, by the way, insider spike was here as well. So sometimes insiders are early to the game, but even if they're early to the game, they have a long-term perspective. They know how to value the company on a long-term basis. So you need to know these things before deciding whether you want to buy or not. Okay, anyway, so after this forced selling, the panic was normalized, and then slowly you drift based on what you think the economy was going forward. So I suspect the same thing's going to happen today. We're going to start drifting now. Whether it goes up or down or sideways depends on the information that we see. So how about now? Okay, so here's where we are right now. Boom. Why I thought the markets wouldn't free fall for a few weeks. So there are more reasons, right? So here we are now. Okay, and I think that a retracement is coming. It's quite likely to happen. Okay. However, here's where I'm gonna say, if you put a gun to my head and ask me, Ken, what do I think now? I will say that even if there's a retracement, it's going to be a bullish retracement, meaning I don't expect the price to test the low here. And I actually think that it's a better than 50% chance that the price does not test 2,500 either. Okay, so for myself, because I know it's overstretched, if it comes down meaningfully like that, I would consider looking for stocks right now. Stocks that start doing your research, do the due diligence, convince yourself that this company will survive at least 1 or 2 years of bad earnings, and convince yourself that the price you're buying at give you really good reward to risk ratios. And so you need to have these things now so that when you do have a retracement, you have an idea of what price you're willing to buy it at. Okay, so for myself, as a safeguard, and this is just for myself, okay, just to give you an idea of how some people look at that. I have a thesis that yes, we have support. To support my thesis, I have this MACD cross. And for myself, I assume that as long as the MACD has crossed, I assume that anytime there's a retracement, there will be support and it'll go up on retracement. So even though it's overstretched, I might not buy now, but I might buy when it comes down here, as long as the MACD does not cut downwards. Okay, now I'm not using the MACD as a magic formula. Please understand that. I'm not saying I will just blindly buy this thing because it crossed. I actually had a thesis. My thesis at that point in time was, hey, I saw, as I said, the VIX is overstretched. I know that short sellers have to close their shorts soon. I know that funds that did forced liquidations will have to normalize what they've done. And I know that at this point in time, a bunch of insiders will jump in and support the price. So I really know that fundamentally, right, this is very cheap. So when I see this cross, it confirms what I really think. So I'm not using this cross as a formula. Now, when I say I'm using this as a guide, now I have a thesis. And this thesis I have is not as so-called strong as the thesis here. Because I was strong over here, but now we've recovered quite a bit. So I'm not that as strong anymore. But I think now that I have a thesis and I'm using this as a guide that I think that as long as this doesn't cross, my thesis is intact. If I see this starting to cross, I'm going to question my thesis and do more analysis. Okay, so I'm using the MACD as a guide to tell me maybe I'm wrong. Okay, let's continue. So why do I think the markets won't free fall? So recap, three weeks ago, it was easier to call that call because of extreme readings. But now guess what? The markets have risen 20%. So all the cheap, the good low-hanging fruit is gone. Now we're going into a new territory. I have to go now from a sentiment analyst and market participant analyst, right, to look at more what's going on in the fundamentals, what's building a narrative based on what I see and what I don't see. So this is a totally new skill set. Okay, and so this one has more guesswork, and I just want to let you know that this one has more guesswork. But with every person that tells you a narrative, you can kind of figure out to yourself which one is more feasible. So I'm going to give you my narrative, okay? So I think that we are not going to take down new lows. My assumption is that we're probably range bound. That means the price might go up, bounce a bit and all that, but it won't go all the way down. And I don't think we can go all the way up either for a while, okay? So my first point is that we have support. Why the markets won't tank, first thing. Now, when I say won't tank, I mean it's not going to free fall, okay? We can still have 10% retracements, but it will not tank like 25%. Okay, why? Four things need to happen. You need support, okay? So for the markets to drop another 25, 30%, right, you need to have something, right, that was really worse than expected. Maybe it's about the virus and all that, right? Or you must have real visible signs that a financial crisis is coming. Okay. Two, if the market's most vulnerable sectors are stabilized, right, I don't expect a free fall, because a free fall implies a financial crisis is coming. So the financial crisis will come when the most vulnerable sectors will fail first, right? So let's look at the two most vulnerable. To me, I think it is the mortgage, MBS, and MREIT sector and oil. These are the two. So let's see information to see whether these two can be stabilized. Third, I actually have a corroboration by a quantitative strategy that I know is going out there. So I'm going to explain this to you, and I think it'll be eye-opening. And four, right, sentiment analysis, which most people don't realize, right, gives room to go either way. Okay, so let's go on. Okay, one, COVID is actually getting more optimistic. Okay, very simple, a few reasons. Vaccines are in development. I see a good stream of news feeds that is vaccines are at a good pace. But to me, this is actually not the big deal. It's really not, because vaccines will probably take 6 months, 1 year, 1.5 years anyway. By that time a vaccine is done, you will know whether you have a financial crisis, a super deep recession or not. Okay, so this is good, not great. What is really great is two other things. One, here, this is the daily new cases in the US. Because of social distancing, right, the new cases is actually tapering down. Once it's tapering down, people feel good because they feel, oh, this might have an end, or at least there's some progress. It's not going to go all the way up and destroy everything. So that's actually good. It's finally tapering down. Second, hydroxychloroquine is actually a game changer. Now here's where I become a news analyst. Let me explain something. The mainstream media, right, is super bearish. They're always poking holes and saying, oh, hydroxychloroquine is not proven totally. There's no real clinical trials on it. Trump is being reckless. And then they say things like that. And they say lupus patients are not going to suffer because of this recklessness. And I go, bullshit. I'm going to be honest with you guys. Bullshit. I'm an optimization analyst. I do statistical engineering all the time. The issue in the economy right now, as in the nation, right, is you don't want the system to be broken. The system is going to break, right, when two things happen. When the infection rate goes out of control and the patients that have the really bad respiratory symptoms, if they all die, or they are in this severe case for many, many days. When that happens, that's when your ventilators are going to get overrun and your hospitals get overrun. That's when you really have a system breakdown, and that's when really a lot of so-called shit hits the fan. That is the main number one thing you have to prevent, that you don't have a surge of people that need ventilators at the same time. And this is where this is important. Think about it this way. Imagine if you're dying of severe asthma. Hydrochloroquine is an inhaler that actually shuts down your autoimmune issues so that you can breathe. And that's the main thing. It means that people who suddenly break down and go into respiratory illnesses, right, and they could die in 2 days or 3 days and they're on a ventilator for 4 days, if you take this thing, and by the way, even though lab results are slow, there's actually a lot of so-called anecdotal cases. The mainstream media says it's anecdotal, like only 1, 2, 3. No, it's not. There are links out there that show that over 70% of frontline doctors say that hydrochloroquine is positive for their patients. 70%. So this is, yes, it's anecdotal. They're basically giving you data on what they observe. They administer it. They have a sense that it's good, but they don't really know. And that's data. when they tell you that 70% thinks it's positive, that at some point this becomes data. But now it is not data. So people like to use euphemisms and say, oh, it's not data, so it's just anecdotal. No, people are doing it for a reason. There's a reason why countries and production companies are starting to produce this thing, because there is actually on the ground evidence that is helping. And I called a frontline doctor in Canada, right? And she told me that. She said, actually, right, I've been reading papers, and the news from overseas in Europe, right, are actually saying that doctors are positive, quite positive on this drug, that it helps more than it hurts. Now, let me explain something. In a scenario of a crisis, right, yes, this drug could have side effects. Yes, this drug might not even work on everybody. Let's say you give it to 100 people, maybe only 30 people respond to it, 70 people don't. But guess what? That means that 30% less potential deaths. That means 30% less people have to go on ventilators. And not just that, think of the compounding effect. When you have a respiratory illness, right, you don't go on the ventilator on just one day. You'll be stuck on a ventilator for 1 day, 2 days, 3 days, 4 days, 5 days. So you're hogging a ventilator for 5 days, right? So if this thing actually helps, right, this thing can help you on the first day. If it helps you on the first day, that frees up 4 days of a ventilator. Can you see? So even if the drug is only 30% effective or even 20% effective, how it impacts crashing over the limit is very significant. So to me, this is very significant actually, because now it means that, hey, some people are going to get cured of their respiratory illnesses a lot quicker. Okay, so that to me is a game changer. Next, the curve is flattened by NYC. So COVID is actually getting more optimistic. Now, you have to be clear that the next time you see more data on the COVID, in my opinion, is when the US opens up again. When the US opens up again, that's when you're going to see news of reinfection rates, and people be wondering, is the reinfection rate too big or too small? Okay, but until they do that, I think on the COVID side, you're going to have like a lull. You know what I mean? Nothing too big or too small is going to change anything. Okay, second point. Second point here, if the market's most vulnerable sectors are stabilized, I don't expect a free fall. The two are mortgages, MREITs, and oil. Okay, we hear a lot of talk about, oh my gosh, the mortgage REITs are going to fail. There's going to be destruction of book value. Okay, that is the news. Let me explain something. At the bottom of the market, the news is always bad. Always bad. If it wasn't bad, it wouldn't be at the bottom. The price goes up, and then the news gets better. So you must understand that. So when you buy when the news is better, the price has already gone up. So you need to be able to see information that majority of the people have been ignoring. And in a crisis, bad news is very, very loud. The good news, you have to look under a rock. So for example, if I told you that mortgage-backed securities that were plummeting have recovered to original levels, is that something you hear in the market? You don't. You have to see it for yourself. So over here is like the ETF of MBB. It's an ETF of mortgage-backed securities. As you can see, because of that crisis, all the mortgage-backed securities plummeted, right? Because people are afraid that, oh my goodness, if this takes people, if 30% of people are unemployed, they can't pay the mortgages. If they can't pay the mortgages, all these instruments can't pay what they're supposed to pay, and companies that own these mortgage-backed securities who are leveraged, right? They will have a margin call, or they will have liquidity problems, right? But guess what? In 1 month, you find that the mortgage-backed security prices looks exactly the same as the gold prices. That's really interesting to me, because now you have to make a guess why that is. And here's what I think. Both of them went down. Okay, gold went down because of forced liquidation. Okay, and this is pretty obvious because whenever you have unlimited QE, that is actually very bullish for precious metals. So fundamentally, right, you actually want to hold gold. You don't want to sell it. So when you're selling gold into unlimited QE, it means that's forced. You're probably forced to do it. Okay. Anyway, both of them recovered. So it seems to me that this is QE that's working. The Fed said that they were going to buy back all the bonds, they're going to backstop all these securities, and they're going to basically buy a lot of things. And essentially, when I see both acting the same way, to me, it just means that this is probably QE at work. Secondly, insiders of M REITs and equity REITs have all been buying their shares. So this tells me that obviously these people will not be doing this as a, individually, independently, if they felt that there was a systemic collapse in the mortgage sector. Of course, there's going to be damage. Don't get me wrong. Their book value of these company book values will go down, but it might not go down as much as the market thinks it will. NRZ dropped by what, 75%, some crazy amount, when their book value actually dropped by 30% in reality, right? Anyway, so the fact that mortgage-backed securities have increased, insiders at M REITs have been buying their stuff, tells me that this sector is stabilizing or is not as bad as we think. Now, of course, this is a guess. Once again, it's all about probability. So if you ask me, which way? Is it going to system collapse or be stable? Based on this information here, I'm going to go, I think, system stable. Okay, let's go next. Okay, just to let you know, this is for you. You can pause the video here if you want to take a look at this. This is just to show you what the Fed has been doing. And basically, they've been firing everything they can fire from March 3rd all the way down to April 9th. Everything. Cutting rates, doing QE, buying this bond, doing that credit facility. I mean, and the most recent, right, $2.3 trillion lending program, extending credit to banks that issue personal pay loans so that companies can continue to pay some of their workers, right? And by the way, let me just say this. This is one analyst said, and one senior analyst said, guys, if there's 30% unemployment rate, it means that 70% of people are still paying their mortgages. So that tells me that as long as this QE is in effect, and let's say that this QE I think is meant to stopgap everything for 3 months, I think. It means for 3 months, right, there'll be enough people paying mortgages. There'll be enough people doing enough so that the economy can still be intact. So I think that for 3 months, right, you're gonna have some support. Okay. All right, next. Okay, so this is another stress point. Oil. So over here is the price of oil, WTIC, West Texas Intermediate Crude. So the price has collapsed to 20 bucks. Okay, this is a problem. I agree. There will definitely be oil companies, right, that are going to go into big losses at this point here, and some of them will probably even go bust. Okay, and if too many go bust, there might be a crisis in the oil sector. So this one is a bit worrisome. But here's what I'm looking at as well. It's interesting to me that oil is low and everyone talks about that. But how come no one's talking about the fact that the energy sector stocks, right? ETF, this is XLE, energy sector ETF, has been diverging with oil. Oil is flat at 20. This is going up. At the same time, if you look at insider trading for the XLE itself, you see record number buying of insiders. The CEOs have been buying their own stocks at record levels at this plunge over here. So once again, here's where my human average investor intuition is strong, making me afraid. But it's always the data that I can't believe that I have to entertain. And I have to go that the CEOs here, right, know something about oil that I don't know. I'm just a retail investor, just like most of you guys. I mean, I'm not in the industry professionally anymore. But even if I was, I'm not an oil expert. I don't know the ins and outs of the oil sector. No one will know it as much as the people who are actually playing the game and who are actually in the commercial companies that buy, sell, trade oil, right? And all of them seem to think that there's not going to be a system-wide problem. If they were, they probably would be waiting and not buying their shares right now. Okay, so once again, I do admit this is worrisome. The longer that this price stays at 20 bucks, I'll be a bit more nervous. Okay, but I've got this hope, hidden hope, that these guys know something that I don't know. So it could be two things. All right. It could be that either oil insiders expect an improvement in the oil price. Maybe they just know the game that OPEC and OPEC Plus plays. they know the demand supply, or maybe they know that if some companies like Shell close down, it's just a matter of time before the rest of before oil actually goes up. And these are the guys that know they will survive, right? But I mean, either way, they're not thinking it's a system-wide collapse, right? Or maybe they think that, you know, the weaker companies going into bankruptcy can be contained within the sector. Either way, right, I would say that if this goes on too long, I'll be worried. But I see green shoots, right? This is like green shoots. Okay, next. All right, my thesis that price will probably bounce around in this range. Okay, it's corroborated by quantitative statistics. Okay, now I used to be a day trader, and I have a CMT. So, you know, apparently I have studied a lot of technical analysis, and I even have a CHOP certified. I can teach, right? Now, okay, I want to say something. Okay, in the S&P, okay, in technical analysis, you hear things like support, resistance. You know, here's a place where I'm very concerned. Here's the retracement, everything, right? In technical analysis, right, one thing that is very, very inaccurate about it is that they apply all these rules, right, to basically almost every asset class. And in a way, you do it because you don't really have any other guides. And so some guide is useful than no guide. But on the other hand, right, these are not really strong rules and strong rules to abide by. Whenever you have a technical rule that you want to follow, you need the real true strategy is that you need some sort of explanatory power. Why does your indicator work? It must work because you know something about the behavior of the thing you're trading on a fundamental level that corresponds to that. So what do I mean by that? Like, many people trade the RSI, and the default is what? 14 days, right? 14 period RSI. And they apply that to every stock, right? They just apply and see what it looks like, okay? So, but why is it 14? Do people even know why it's 14? You see, before, there were some people that used the RSI 14 for actual explanatory purposes. It used to be used for a commodity trading, like agriculture commodity trading. And so, because of that, people tried to, they rationalized that some cycles occur because of the lunar cycle, which is 28 days. So trading a cycle of 28 days is that you cut it in half to 14 days, and that helps you to measure basically an actual cycle. Can you see that they use the RSI technical indicator on the price because they thought that the price of what they were trying to measure actually responds to a real 28-day cycle thing. So there must be some explanatory power. And then if you do have explanatory power, it's like you can have more, how do I say, conviction in these levels. So what I want to say is this. Over here, this blue line is, sorry, this red line here is actually strong support and strong resistance. The blue line here is actually medium strength or medium resistance, okay? I don't think we can trade past the blue line unless there's really, really some game-changing news. Like maybe, for example, the first few companies report this quarter, and it turns out that, you know, Wall Street was expecting them to lose 50% of their earnings, and maybe they only lose 30%, for example. You know, that might cause it to go above, okay? But if it's to expectation, it's not going to trade above, okay? We won't likely trade above the blue line. We won't likely trade below the red line. So what I mean by trade is that unless some real fundamental game changer occurs, I don't see, like traders won't be able to trade this thing past this very much. Neither will it drop here, okay? But of course, I'm actually bullish, so I won't be surprised if we hang here for a while. Maybe you peak out, maybe you actually do, I don't know, right? But I think that this red line will hold, at least for now, until there's more news. Don't forget, US hasn't opened yet, so reinfection rates won't be an issue until a few weeks later. We have to wait for earnings to come out, and you need to see really bad news to tank this lower, okay? I won't be so I'm just gonna say I won't be surprised if we stay in this zone over here. That's all I'm saying, okay? It's all probability. That's just my guess, but I don't think that we'll take out this red line. And even if we do, it might bounce above. That's just my view now. It can change in 2 weeks' time. All right. I can only give my honest perspective. no one can tell the future. I'm only giving my honest perspective based on my argument here. So if you disagree with the argument, I mean, you can disagree, it's fine. But I'm just letting you know what the argument is. Now, why is that so? Okay. Right here. This is the S&P for the last 20 years. I want you to look at the red line that you saw, and you look at the blue line that you see here. So just take 10-20 seconds to look at it carefully and just see how the price interacts with those two lines. This is like two in one tea, no sugar. When you get old, you gotta cut the sugar out. Okay. Alright, sheep's getting bored. Gotta continue. Okay. Okay, this is what you notice. Look at the red line here. It's super strong support, super strong resistance. Whenever a price hits it, and if it gets out of it, and if it significantly gets out of it, it tends to stay above. See that? Boom, tends to stay above. But then, if you plunge through it convincingly, it becomes support. When you try to get back there, it bounces off. See that? The initial ginormous bull run, first wave bull run from 2009 to 2010, isn't it very convenient that everyone took profit at the red line right here? And then once you finally got out of it on the second try, that basically finally put you above the red line, and then you continued above the red line for the longest time. See, it keeps bouncing off. Okay, so this plummeted down here because of super duper fear and forced selling, right? But now that the market has finally taken a breath, it has actually convincingly gone above. So history tells me in the last 20 years that the next time the price comes down here, you should get at least one bounce like this. See? Boom, one bounce. Okay, it'll bounce. But whether it stays above, but once it bounces, I can't tell you whether it goes all the way up. Or maybe it just bounces and then it comes down again. I can't tell you. But I know that at least on the short to medium term, this is strong support. It will absorb the first bounce, okay? And the blue line here is also another signal line, but it's a medium signal line. So same thing happens, but on a lower time frame. See, okay, like for example here, when you break below, there's a tendency to stay below. See that? And when you break above, there's a tendency to stay above. Okay, but this is a weaker line. Now, here's the thing. You might be saying to me, Ken, I thought you told me technical analysis, right? You need explanatory power. Okay, let me explain what's going on here. These two lines that you see here, oh shoot, it really should be the 70. Okay, this should be the 70 moving average, not 50, okay? The 70 looks a little bit different. If you use 70, the blue line becomes more curve fitting. Okay, so the 70 moving average, and this is a weekly chart. It has to be weekly. The 70 and the 200 moving average on the weekly, and please, don't share this with people. I mean, seriously, don't share this with people. You know, especially people that think that they are day traders and all that. Just don't share it with them. Because it took me a long time to actually find this out. And initially when I found this out and I tried to talk to professional people, they actually, they dismissed me. I remember 15 years ago when I was a noob, you know, and I was working and I was an intern in a brokerage firm. I was just learning from scratch, and of course there are many things I didn't know, but there were some things I was discovering, and I saw, hey, this is very interesting, because I had to read over 20 books, right, to find someone talk about this, and I looked at it myself and I realized, oh my gosh, this really is an optimized trading line, meaning this is the line that if you statistically use a computer to try to analyze what line do you want to follow if you want to do a trend trade, right? That's the blue line. That means every time you break below the blue line, you will take the trade. That means you break below here, and if it stays below for 1 week, go short. If you break above here and you stays above for 1 week, you go long. If you do that, yes, you'll get whipsawed here and here and here and here, but you will also take a very long trend. You will make quite a bit of money. So you lose at whipsaws, but you make at some of these places. And And then if you want to do mean reversal strategies, right, the red line, right, is very, very key as well. That means whenever the price goes too far away from the red line, right, there are some algorithms, right, that will trade you closer to it. So anyway, the point is that these lines, right, are optimized lines for many types of strategies, whether it's trend or even reversals. So why do I care about that? Because in the market, right, there are many different types of participants. You have day traders, you have technical people who want to trade every swing, but you also have a lot of algorithmic traders, you have a lot of systematic traders, robots, quantitative traders, and these are really high volume and they take up a big part of the market. And those people actually use these lines. So because of that, I know that when you get close to any of these lines, right, there's a whole bunch of robots waiting to take the other side. It's an actual support, like a real support, you know what I mean? Now, of course, these people take up only some part of the market. So it's possible to go above those lines if the fundamentals are great and a lot of funds pump in, right? But the point I'm trying to make is that if you don't have very strong fundamental news, either way, bad or good, you probably won't be able to break any of these lines because the traders can't break it by themselves. You know what I mean? So that's the reason why this has some explanatory power, and this is only fitted for the S&P, not anything, not other stuff. Good technical analysis is usually limited to one thing, like you tweak your parameters to one thing, okay? And in this case, it is explained. And by the way, and how do those quant funds or algo funds, right? How do the computers do this? They usually roll their strategy, meaning the computer, every week, the computer will calculate in the last 20 years or 10 years, right, what has been the optimal moving average. And then they'll base that moving average as the trading line. That's why these optimized numbers has explanatory power, okay? So the point is that we've gone above the red line. So at blue line, unless you have really good fundamentals, hard to break out. But at the same time, unless you have really bad news, hard to break down the red line either, okay? Pro tip, don't tell anyone. Okay, last thing. The stuff I'm telling you now, right, are things that I'll say that very few people know. They might know one or two things, but they probably have never put them together this way. So when you see this, you actually have an edge, all right? Now, number 4, sentiment and analysis gives room for either way. Okay, so it is true that, okay, so this is the price here of the S&P. It is true that we made a big move down, and then we made quite a sizable move up. And so most people that look at price, technical analysts will say, oh my goodness, we moved so much, we're really overstretched. Remember, we're only overstretched if you look at the price with the naked eye. We are not overstretched in other measures. If you look deeper into the technicals, and I call this X-ray technicals, you're looking at the price, and I want to know what's going on inside this price. You see a different picture. Now, this thing down here is the smart money, dumb money confidence. Now, this smart money, dumb money is not what I was talking about before in terms of like insiders and whatnot. This is calculated in a different way. So, to make it simple for you, smart money shows the trading bullishness. So blue is that, right? So when you're high above here, it means the smart money is more bullish. Smart money is measured basically by the trading volumes of companies that don't speculate. Okay, so there are many types of companies or traders that buy and sell shares, right? Some people buy and sell shares because they're speculating, meaning they really want to trade. They want to buy it low and they will sell it high. They see a trend, I'm going to buy it and sell it later. You know what I mean? But some companies actually buy and hold stocks for either hedging purposes or they're using it for their daily operations. Maybe they are a brokerage, so they buy it and they have to store it somewhere. So these people are stronger hands, okay? So usually, especially on the short term, medium term, right? If you know that the stronger hands are buying and the speculators are selling, then there's more room for the price to go up, right? Because the strong hands are holding and there's holding. So it's just a matter of time before traders decide to go the other way. So that's what you see here. Notice every time the price goes down in a meaningful way, you'll see the smart money go up and the dumb money go down, especially here. See, when the price went down here, smart money went up, dumb money tends to go down. And then when you're at peaks, so let's say here, the price went all the way up here before it came down, right? Look what happened. The dumb money went from extreme, from very, very bearish to very, very bullish. Look at that. So when the dumb money was the most excited, you're at the top. When the smart money was not interested in stocks, right, it's the top. What do you see here? Interesting, right? Even though this is actually a very big move. But when you look under the hood, you realize, hold on, the smart money are still relatively on the bullish side. So what does this mean? Can the price plummet down? It can. The price can plummet down and smart money will probably end up going up this way. I agree. But this shows that there is room for this to go up because the smart money is still on the bullish side. These are the strong hands, you see, they're strong. These are weak. So usually until this line gets more than halfway or on the other side, right, that's when you start to say, you know what, maybe it's really something's, yeah. So anyway, the point I'm trying to say is that, yes, I know it's overstretched. Yes, I know we're going into the, the 70-week average might turn around. But what I'm saying is that, hey, actually the smart money is they're not bearish. They're still collecting stocks. So that gives you another level of support. See, these are all the levels of support I'm giving you. Okay, so all right, so 4 points. So let's summarize this. 4 points of support. COVID is stabilizing temporarily. Things can change. When the fundamentals come in, we'll see more things. But as of now, it is stabilizing. 2, the market's most vulnerable sectors looks like it's stabilizing. Mortgage REITs looks like it's stabilizing. Oil, I hope that oil starts to increase in price. And I just think that insiders buying their own shares tell me that there's a better chance that there is than not. Okay, but of course, this is a stress point, meaning if oil goes on too long, that means my thesis for market support is down, and then you have to kind of think about, okay, so my point is that I think the support, these are my 4 points. If you disagree with them, it's okay. That means that my support is not very strong. So this is my thesis. Okay, number 3, corroboration by quant. I told you about the 2 main lines that if you manage to clear, it's really bullish or bearish. Okay. 4, sentiment analysis gives room to go either way. So I'm saying that there is some support based on what the commercial guys are doing. Okay, so that being said, the support. So how do I? What are the bad things, right? Okay, so but we are coming to resistance soon. Okay, so it's possible that we actually retest the red line, which is the price goes up, hits, and maybe it comes down and gets closer to the red line. However, on the longer term, until the fundamentals point otherwise, I am actually more bullish than bearish. Okay. My assumption hasn't changed, that I think we are range bound and we won't take out the lows. But of course, all this can change in 2 weeks or 4 weeks, okay? I'm only giving my honest perspective like right now. And personally, and this is not an encouragement to trade, I'm just giving education as to how some traders think that, traders like me, some of us will have positions since 3 weeks ago, but I also have cash. So I'm not totally in, okay? I'm not. I've gone in because that could have been a bottom, and I wasn't sure if it was a real bottom, but I knew it was a major bottom. Okay, since I know it's a major bottom, better put some money in. So I put some in, but I'm not sure if there's going to be another bottom, so I kept some cash in case we have another bottom. That's just me, personally. Okay, so question of the day. Where are we? So this is just a chart of a bull market, okay? I mean, I just use it because it was convenient, okay? So usually when you are at the bottom, the price goes up, then you have a retracement here, okay? And the first retracement in the bull market is called a shakeout, meaning people who bought here had no conviction in the bottom and they sold, right? So the question is this where we are right now? Because now we might start to retrace, okay? We're going to retrace. So the question is, when it does retrace, are we here? Meaning that it's actually going to be slowly drifting up after that. Okay, we are yes and no. So I'm going to tell you the case for yes and no. So 1, yes, because we actually have insider buying in stress sectors, oil, REITs, and Dell, the computer company. Okay, it's not stress, but I like the fact that he's buying. Okay, we have some insider buying in stress sectors. That's good, but we don't have it in some other blue chip stocks. I was hoping to see more insider buying in blue chip stocks, but we didn't. So it's kind of like a yes and no, half signal. Okay. Upside is capped for now. Okay, so the upside is actually capped. I'll tell you why. Because One big support in the market is actually stock buybacks. Companies were buying back their stocks because they were leveraged, they had money to spend, they want to buy back their stocks. And because of the COVID thing, dividends are cut, stock buybacks are cut. So you've lost one participant that pushes the price up, the actual companies themselves. Okay, so that upside is capped. Okay. And of course, there's a perception that the economy is still fragile, right? People are still wondering what's the financial damage. So I don't think the price can go too far ahead. Okay. But at the same time, the downside is also capped because we know that if the price actually starts to get lower, when it gets as low as what the insiders used to buy, I know there's a lot of value investors, right, that will jump in because they missed out the first time and they're going to come in at that point. And that will cause like a support as well. Okay, there are lots of very, very, very disappointed people of people with money who are value investors, but because they're not market timers like myself, and they laughed at people like me when I said it was a bottom, they missed out on the whole 20% move. And these people are very anxious to get back in. So because they're value investors, they only want to buy when they think it's of good value. So buying at the insider price or near insider price is a good gauge of value. And when it gets down to that price, they will come back in. Okay. Also, QE, I know you can't see this. QE is a neutron bomb. Okay, it's a neutron bomb. The amount of QE in the market right now is ridiculous. Okay, so that's a good side. That's why I think the downside will be capped as well. Now, as it stands, right? Oh yeah, this is a percentage I ascribe to myself. You need to form your own opinion because you might have a feel or on the market that's different from mine. You might be seeing something else I haven't seen. So for myself, I give an example. Maybe I think that 50% we don't get a low bottom, that we saw the actual bottom. And 50% we drift. Remember I said, after the first move, capitulate, bam. Then we will quickly normalize to something more reasonable. Then fundamentals will tell you whether you drift lower or whether you drift sideways or whether you go higher. Okay. Okay, I say 50% we don't see a low bottom, 50% we actually find a low bottom. However, I feel that after what we just had, even if you find a lower bottom, it will not be very much lower. You know, like maybe it will be 25% lower, but not like 50% lower. Okay, that's just my own opinion. So what you can do, okay, if you really want, and I'm assuming that you're a retail investor, meaning I'm assuming that you don't want to trade, you're sick of losing money, you just want to buy some good stocks and at a good price and hope that a few years from now you have good money, right? That's what I assume that you want. So I need to caution you on a few things about buying now, okay? If you buy now, right, you need to have a strong hand. It's very difficult to buy in a bottoming market unless you have a strong heart and a strong hand. So we'll talk about what I mean right after this. Okay, so here are the tips that I have if you're a retail investor and you're in an environment where you don't know if there's a bottom. Okay. Now, the one thing that you cannot take is you cannot get whipsawed. At the bottom, understand that prices are very, very, very whippy. It will be whippy at bottoms, okay? And if you watch my last video, you will see that many average investors lose money at the bottom than make money. It's a very sad thing. And the reason is because emotions and what they don't understand. They buy, but then the moment the price drops down 10%, they think, oh my gosh, something is wrong with the company, I'm out. And then the moment they get out, the price goes up by 20%. Okay, so this will happen. It happened to me in 2009. It even happened to me this time around. You know, I had a few trading sessions, and one or two or three of them, I made the mistake, and I'm like, damn, even for myself, I'm in the veteran for so long, right? And yet even I'm susceptible to it. That's why I gotta use very strict rules and see and know my facts, and take the fact and try to distill fiction and go with it. Okay, so here's my tip for being strong. 1, you need to buy stocks that you have done your due diligence with. You have to do it. You have to do it. And you are convinced they can survive at least a whole year with poor earnings. Okay, you have to look at it. Okay, and you have to be convinced. If you're not convinced of this, if the price drops 20%, right, you know what's going to happen? You're going to sell it. If you're convinced about this, it drops 20%, you know what you're going to do? You will buy more. You will. And then you'll make multiples after that. So please do your due diligence. That's the reason for myself. understanding my limitations, in a crisis, for me, it is especially important to buy stocks that have insiders with recent significant buying. Because this is a +1 indicator that tells me I'm not crazy. That I thought it's cheap, they thought it's cheap. So maybe I need to contemplate, instead of thinking of exiting now because it dropped 20%, I gotta ask myself, hey, at what point am I gonna inject the rest of my money in? Right? That's the mindset you need to have. 3, don't be in a hurry, because the jury on the COVID crisis is still out there. You are definitely going to see days where it goes up by 8-10%. You will probably see days where it goes down 5 to 6% as well. So if it goes up too quickly, just be patient, or you can find another stock to look at. Okay, and then if you are buying now as a retail investor, you need to entertain 2 possibilities. Don't think. I advise you not to think binary, meaning one or the other. It's like people are thinking, oh my goodness, is it bottom already? If it's bottom, I must buy right now. Everything, boom. Or you might think, it's definitely not bottom, it's definitely not bottom, so I'm just gonna not do anything at all. Both of them are actually dangerous, especially at these low levels. Because, and you know why? Because if you buy it and then it goes down, you put everything in and it goes down another 30%, right? I mean, you're gonna feel really, really horrible about yourself, right? Because you can't even average down your losses. Similarly, if you didn't buy it, and that's what many people, many value investors that I know did, and these are not dumb people, by the way. I'm talking about tycoons. I'm talking about people that read Goldman Sachs reports all the time and have fund managers reporting to them. I'm talking about those people. If you saw my last presentation, you'll see why even that's a very limited understanding. Okay, just because you have a name Goldman Sachs, it doesn't mean that you are that much better than most other people. Okay, but anyway, what's my point? Oh yes, so either way you want to avoid. What you need to do is because you need to steal your emotions. You need to be able to be at peace, and you need to be able to be at peace with your decision, and you must sleep at night. If you cannot do these things, you're going to make bad trading decisions. Okay, so one way of doing it is like this. Ask yourself this question: how much money can I reasonably make? Okay, so I'm going to give you one example. Okay, let's say one stock. It's a good healthy stock, won't go bust. Let's say right now it's $40. Okay, $40. And let's say in March, before all the crap happened, right, it was $80. Okay, so before COVID crisis, $80, now $40. Stop looking at the stock price. Ask yourself one question first. And this is something that's realistic, okay? Ask yourself this. Hey, if I wait 4 years, that's a good, reasonable amount of time for the US to recover, or most world markets to recover, and you will likely get back to very similar levels in 4 years. That's reasonable, okay? That means that the price of this stock will likely go from $40 back to $80 in 4 years. Okay. That means if you buy it now, if you're just doing simple division, it means that you're going to average a gain of 25% every year in that 4 years. That's how you think about it. And then you go and also at the same time, maybe that company is giving an 8% dividend because price is so low, right? Wow, that's giving me a 32% gain every single year. Then you ask yourself, am I okay with that? And the moment you say, I'm okay with this, okay, then that's good. So that means that even if the price goes down another 20%, you're going to go, oh well, shucks. I missed 20% more gain. I missed it. But guess what? I'm going to get 35% every year for 4 years. As long as I know that I don't need this money for 4 years, I put it in, don't take it out. Okay? You can do that. And then you can do an additional thing. So you go like this. Okay, the worst case scenario is that another bottom is going to happen. COVID will take longer for some reason. And maybe, the economy can't recover fast enough. And maybe the bottom will be taken out. But, even if you get taken out, I don't think it will drop by 50%. I think it will drop by maybe 30% max. I mean, that's what I just think, right? Okay, so let's say it drops by 30% max. Okay, how much money do I need in my bank account, cash, such that if I buy it 30% cheaper than the insiders, don't forget, you're going to be buying these companies 30% cheaper than the insiders, okay? When that stock finally recovers, right, you won't be making an additional 30%. You know what I mean? When it goes all the way up back over there, you're making multiples more. So you can go like that. Okay, if I put in 70% of my investment now, and I keep 30% cash just in case there's a bottom, I'm okay with that. That's how you should think about it. If I put in 70% now and there's no bottom, okay, how much money will I make? You probably, if you buy stocks that are close to insider price, right now, even if you spend only 70% of your cash or 75% to invest, you're likely going to get 25% a year if after 4 years. You're likely, even if you don't put in that 30%. So, but if you do get a bottom and you average down with the 30, right, you're still going to make, you're probably going to make more, like maybe 30%, 35% a year after 4 years. So after you do that calculation, you know that these companies will survive, you're going to make that every year, then you just go, okay, at this price, I'm willing to go in it. And if you're not willing to do that, then you have no choice. You have to be patient and you hope that the price comes down for you to get a better price. You just have to. If you are too nervous about the market, you're too afraid where the market is going, it means two things. It means either one, you don't know the company well enough, you just think it's really going to go bankrupt even though you don't have enough information, or you invested too much. You put too much money in. So you have to reduce accordingly until you can sleep well at night. And this is my important thing. The reason why prices are at the bottom is because it's very emotional. Nobody is immune to it. People that can control their emotions the most are going to be the ones who do the best. Those who are patient and emotionless. Okay. So last piece of advice here is just remember, especially if you're a Christian, here's where the Bible really comes in. For God didn't give us a spirit of fear, but of sound mind, right? He gave us a spirit of sonship. He gave us a spirit not to fear, but of sound mind. And whenever you are getting overwhelmed, right, retreat back into your identity as God's son, right? And then ask Him for wisdom. Ask Him to recenter your priorities so that you can see the market differently. You need to see the market as a slave, not as a master. And when you are assured that God has a plan for you, and when you have set yourself that your priorities is about following God's way instead of your way, you tend to make more rational decisions. You'll be able to put your money in and go, it's okay, I'll put my money in and I'll find something else to do. God will help me find something else to do, and that will help you a lot. So I hope all this has helped you. So this is my market outlook. Okay, don't forget to subscribe to the Facebook group here, Kwan Zombie here, website here, and what else? Oh yeah, over here. So if this post have blessed you, okay, please send us the email, let us know, ken@kwanzombie.com. Okay, and if you want to help keep the lights on over here and have more of these videos that took me basically 20 hours to do and upload, hey, right, please send a love gift over here. I will really appreciate it. So will Sheepy over here. He'll also appreciate it. Okay, so if you don't want to help me, help him. Okay, he really needs it. Look at him, he's just so cute. So yeah, Singaporean donors use for PayNow, and international donors use the PayPal over here. Anyway, these links, right, I'll put it below over here as well. And finally, right, this video, please help support. Put a like on it, subscribe on it, drop a comment, drop a like. Hey, any questions about the presentation or future questions you want to have, just put it down and I'll answer you in the future. Okay, so okay, thank you very much. God bless you. I'm out. Sheep's out. Coffee's out. Okay, bye.